kind of putting you on the spot here. I don't know if this is even doable right now, but I'm just thinking, I'm envisioning like a one-page PDF that a land investor could use to say, hey, look at these things. Like, given that it's non-owner occupied vacant land, this is just a standard thing. I mean, obviously change it if it needs to be changed, but like what would be those bare essentials that a person should look at?
Yeah, absolutely. Great question. So again, what we're talking about is default prevention, right? So ability to repay certainly has to be one of the elements. That is, what kind of monthly gross earnings or access to capital does this individual or entity have? So there, no matter how you dice it, there's going to have to be a look at earning and cash flow consistency and capability over a 24-month period. Whether that's individual or entity or a combination of both would entirely be up to our discussion based on the scenario you gave me at that time, you know. And then besides access to capital, you know, then there certainly has to still somewhere in there be some sort of a look at credit worthiness, right? The financial history of this either entity or individual. In other words, when we look this person up, do we find out that they're currently defaulted on 10 other ventures similar at the same time? That'd probably be something you'd want to know about and you'd probably want to run from. Or maybe we look them up and we look up their entity and we can't find anything on either one that indicates that they've had any problem. Maybe they already have 2 or 3 credit sources out there and those credit sources are all in good standing and always have been. So that kind of thing, you know. Or maybe it's an entity that they want leverage against, but that entity is so new in origin, there's just nothing on them. There's no history at all. It's like they just, you know, sat down at a diner and wrote the thing up yesterday and now they want to borrow a bunch of money against it. And there is no history to even vet. It's nothing but goodwill and pie in the sky. And again, you'd probably want to know about that as well. You know, and then just the other issues would be maybe a very simple form of cap rate or debt to income ratio with respect to this person's hoping to float this thing with, you know, what type of capital from what source. And when we examine bank records or P&Ls, does it look like they have the kind of discretionary capital to absorb this much more debt, right? Because I'm guessing most of the time in your business, you're not looking at the asset being capable of providing its own debt service. So if somebody's going to buy 5 acres of land and it's not currently rented, then that 5 acres of land can't be brought into the equation in terms of its ability to float its own debt service. Whereas if you're buying a sixplex, absolutely, right? We'll look at rent rolls and we'll see what the monthly earnings is above expenses on this and some sort of a ratio that will tell us, hey, okay, this thing, you know, is gross in $6,000 a month, then the new loan would be $2,000 a month. And after all their other expenses, they still have about $4,000 a month left. Okay, so we underwrite, again, totally different based on the scenario. And so your investors would come to me and paint a picture of what this particular venture was and what it looked like. And then that's how we'd kind of derive a strategy for here's all the things we should probably look at with this one to make sure that you're safe.
I think what you're describing there, it actually sounds like a fairly short list because, you know, I'm sure you're familiar with like the 5 C's of credit, which is kind of like this cute little thing that we use in the credit analysis underwriting world. And those things are character, you know, the borrower's character, like are they a good person, capacity, capital, conditions, and collateral.
Absolutely.
And those things, those make a ton of sense when you're talking about like a multifamily owner-occupied property or like a business, that kind of thing. But when you're talking about vacant land, the C for collateral value, like a lot of times that's really hard to quantify, and that's why banks won't get involved. Things like conditions, so like external factors like the economy, like is our jobs going away, this kind of thing. That also is less relevant to vacant land because a lot of times vacant land isn't generating income. It's not really dependent on the economy per se. But the things that do matter a whole lot is really just that person or that entity. Like what cash do they have access to? Like, are they a rich doctor and they could pay it off today if they wanted to? Because if so, that makes it a pretty easy thing to underwrite. With vacant land, like you don't have as much to sink your teeth into as the borrower, but what you do have is that individual or entity's financial resources, if they have them, and their credit history also. Like, do they actually do what they say they're going to do? And does the history show that? So, so what you're making or what you're saying makes a ton of sense.
Yeah. And we could still always soften and massage the Dodd-Frank requirements and then weave them into something that is a little more flexible but still honors a similar intent. Like in lending, if somebody has a credit score under a certain amount, then that automatically triggers certain conditions, right? In other words, by virtue of the credit score alone, that tells us that we better verify a few extra things. If somebody's got a 850 credit score, we're probably not going to worry about whether they've been on time on their last 12 mortgage payments. The credit score tells the story. They absolutely were, or they wouldn't have an 850. If somebody has a 430, then we might say, okay, yeah, I see they've got 12 months of bank deposits. Yeah, they're cash flowing, no doubt about it. They're making good money. But the 430 credit score is telling me there's something there, right? They've burned somebody, that we better look a little deeper. Maybe now we want certain other proofs of positive payment history for the last 24 months, or we want to dig a little deeper because what life event brought this person's credit score down to the train wreck level, despite the fact that we see positive history of great earnings.
Yeah, I appreciate what you're talking about now, because I know sometimes people have this mindset, maybe because they don't really understand credit reports, but they'll think, hey, if the score is 500 or below or 600 and below, then no, it's bad. But it's like, well, maybe, but you got to look and understand, like, why is it that low?
Yes.
And can it be mitigated? Is there a story behind it?
Yes. And one of the things that we do a lot of is investigation to understand the why. And then this is where Fannie and Freddie lenders don't, right? Because they don't have to, quite frankly. They're picking low-hanging fruit, right? So since they are churning a Wall Street-backed investment with a bunch of extremely risk-averse investors, they just draw an arbitrary line in the sand and they say anything under 580 we're not going to look at. You're gone. And seller finance is taking that market share that the bank is willingly walking away from, and then we're sifting it for the few nuggets that are within that demographic that Fannie and Freddie has just automatically written off. And so the idea in underwriting is to sift these borrowers and find the sweet spot where we're consistently mining out the ones that are still going to make great performing note holders, but they just happen to, for whatever reason, fall below the metric that the Fannie and Freddie lenders are, gathering up with both hands as they run through the field. For example, if we look at a 430 credit score, we don't just kick them out the door because they're under 580, but we do employ some filtering methods to say, let's find out if this was a one-time life event versus if this is a life pattern. And what you're hiring me to do is to make that judgment call based on doing investigation to figure out, is the low credit score indicative of poor credit and poor character, or is this a good person and this is a good entity, but hey, during COVID, they got their doors shut by radical government that said you're out of business tomorrow no matter what, because Dr. Fauci says your customers aren't wearing 5 masks, so you're shutting your doors, and overnight your earning potential went in the toilet. But for 10 years prior to COVID, you kicked ass, and now the year after COVID, you're back to kicking ass. And so we're able to look at that credit score and really connect the dots and understand that, hey, you know what? This guy's not the credit risk his credit score would say he is. And so that's kind of what we do we don't do automatic underwriting, which is what all the banks do. So they spit the document into a machine and, a bunch of lights flash and it kicks it back out. And while the lender's out on the golf course playing, when he comes back, all of his loans are already underwritten, and it just tells them an algorithm, he's a yay, he's a nay, he's a yay with conditions, and he's a nay no matter what. We don't do that. We manually underwrite every single one of these, looking at you and your needs and your borrower and the deal, and what makes good sense for all parties involved on an individualized basis.